Kraken. Let's have a look.
In 2011, the most important Bitcoin exchange in the world collapsed. A man who helped clean up the wreckage came back and built the exchange that was supposed to be different. Security first, proof of reserves, 14 years without a major hack. Then in 2022, he told employees who felt triggered to take 4 months severance and leave. He stepped down. The exchange settled with the securities regulator for $30 million over its staking program. Then it spent $1.5 billion acquiring a traditional futures broker, raised $800 million from two of the most sophisticated firms on earth, and filed to go public. And in August 2025, when a deposit error the exchange admitted was their fault triggered a margin liquidation, they refunded the deposit but refused to cover the losses their own mistake caused. The exchange built to never be the thing that collapsed is preparing for a stock market listing. The question is what it became along the way. The collapse he witnessed was not a minor failure. That exchange handled roughly 70% of all Bitcoin trades on the planet. When it was hacked, the organization could not tell the difference between its own assets and its customers' assets. Private keys were poorly protected, customer funds were mixed with operating funds. The entire structure was a disaster dressed in convenience. The founder of Kraken watched all of it and decided every design choice would be the opposite. Proof of reserves published cryptographically so anyone could verify the exchange held what it claimed. Cold storage for the majority of customer assets. No co-mingling. The founding thesis was not about being the biggest, it was about being the one that could survive what destroyed the other. For a decade, that philosophy held. No major hack. One of the first exchanges to pass a proof of reserves audit. The company bootstrapped before raising modest early rounds and remained private for over a decade. A reputation in the community as the serious alternative to the larger American competitor. Then in 2022, the founder circulated internal documents describing the company as crypto first, not culture first. No diversity initiatives. No required use of preferred pronouns. Firearms welcome at company retreats. When the coverage went national, he doubled down. Employees who disagreed could take 4 months of severance and leave. Walkouts followed. The founder stepped down in September 2022. His chief operating officer became the new chief executive. The founder became chairman of the board with an estimated quarter to a third of the equity. The exchange kept running, but the person who built it was no longer leading it, and the regulators were already closing in. 5 months after the founder stepped down, the securities regulator settled with Kraken for $30 million over its staking program. The exchange had been pooling customer assets, staking them on their behalf, and advertising returns as high as 21%. The regulator determined this was an unregistered securities offering. The exchange earned $147 million in staking revenue over 3 years. The fine was roughly 20% of what they made. Kraken shut down staking for American users immediately. The larger American competitor was sued for the same thing on the same day. The competitor fought. Kraken settled. One of the regulator's own commissioners published a dissent arguing the regulator was overreaching. The settlement became one of the most cited cases in the debate over whether crypto staking is a security. Before the staking settlement, the commodities regulator had already fined Kraken $1.25 million for offering leveraged trading to retail customers without registering as a futures merchant, and the sanctions authority had fined them $362,000 for failing to block Iranian users from the platform. 826 transactions processed for users in a sanctioned country because the geo-blocking was inadequate. Meanwhile, a user wired $49,000 to fund a new account. The account opened, but the funds never appeared. Months later, it remained unresolved. Another user wired $175,000. The exchange said they never received it. That case was eventually resolved, but the user could not reach a human while the money was in transit. Another user's positions were liquidated despite claiming a margin health ratio of 400%, well above any standard liquidation threshold. Kraken never responded to the complaint. The regulatory settlements were survivable. But the question of what happened next with the money was about to get much more interesting. In March 2025, Kraken announced the acquisition of a traditional futures broker for $1.5 billion. The broker serves approximately 2 million traders in traditional markets. The acquisition brought regulated futures infrastructure, professional charting tools, and a user base that had never held a crypto account. The thesis was one platform for crypto, futures, stocks, and tokenized assets. The distinction between traditional finance and crypto would blur, and Kraken would be the bridge. 8 months later, two of the most sophisticated trading firms on the planet invested $800 million at a valuation of $20 billion. In March 2026, a confidential filing was made with the securities regulator targeting a stock market listing by the end of the year. The filing was paused after a price decline in the broader market. Crypto exchange valuations track the price of the underlying asset, making volatile periods poorly suited for a listing window. The founder still holds an estimated quarter to a third of the equity. The listing would be the largest liquidity event in the company's history. Kraken has not held a license to operate in New York since 2015. The financial capital of America cannot use the exchange. 11 years without applying, the platform has recorded over 40 outages since 2020, roughly one every 7 weeks. During high volatility periods, the app has failed to execute sell orders, with support blaming terms of service and suggesting users switch to the professional interface. One user watched a position drop from 1,300 to 100 while unable to sell. The exchange is building for an institutional future, while parts of the retail experience still break during the moments that matter most. Kraken is the exchange with the best fee structure among compliant American crypto platforms. More tradable assets than the larger competitor. A staking commission that takes roughly half the cut. A subscription tier that offers 20 times the fee-free trading volume at the same monthly cost. 14 years without a major hack. The founding philosophy held where it mattered most. The security worked. But the founder's departure left a culture war legacy that still surfaces in coverage of the company. The staking settlement cost $30 million and shut down a program that earned $147 million. The commodities regulator fined them for launching a product without completing the registration. The sanctions authority fined them for failing to block users from a sanctioned country. 11 years without a New York license, over 40 outages since 2020, a deposit error the exchange admitted was their fault that triggered a margin liquidation they refused to cover, and a $75,000 margin liquidation complaint they never answered at all. For an active trader who does not live in New York and uses the professional interface rather than the standard one, this is the most cost-efficient compliant American exchange. The fee difference over the larger competitor is real money at any meaningful volume. The futures infrastructure through the acquisition is genuinely differentiated. The security record is the strongest in this series. But being secure is different from being responsible. The exchange that was built to never be the thing that collapsed is filing to go public. What it does with that money will answer the question the founding thesis never addressed. Every choice is a trade-off. At least now you know what you're trading.